Are all profit margins the same? In this video, I explain how gross, operating, pre-tax, and net profit each capture a different layer of company's performance. Let's start by establishing what are the appropriate synonyms for the word profit. If you looked at the financial statements of a company and you saw the terms earnings or income, that is perfectly acceptable. That is another way to say profit. The differences between the choice of the language across the firms, the fact that one firm might say net income and another firm might say net earnings, doesn't really signify anything. There's nothing for us to read into in terms of the signal, and these things all do really mean the same thing. And very importantly, all three of those words are completely not synonymous with the word revenue. Revenue is the top line of the income statement. These are just the sales to your customers. When we're talking about earnings, profit, or income, we're talking about revenue minus expenses. Now, what expenses exactly are subtracted? That's going to determine what type of earnings or what type of profit that we're talking about. So let's introduce the different layers of profit on the income statement. On the top of the income statement, we have the sales, and then we have the expense, which is most integrally connected to the generation of those sales. We have the cost of sales. That's also known as cost of goods sold, cost of products sold. For a service company, it might be called cost of services provided. But again, this is something that is fundamental as it relates to manufacturing or retail firm. I discussed the cost of goods sold in the prior video, how it makes its way from being an asset inventory on the balance sheet into being an expense on the income statement. This cost does not include any of the supporting operating activities. It just is about the preparation of inventory or the preparation of services to be delivered to the customer. Now, once we move down the income statement, we say, okay, what are the other activities that the firm had to undertake in order to run their business? If we go the next level and do gross profit minus operating expenses, then we have the operating profit. Operating expenses will be a lot of the things which are necessary to run your business, starting from the CEO salary to R&D and marketing, etc. On the next level, after the operating profit, we will take care of the financing items and of the transitory items, so something that is not recurring with the same regularity, and that will get us to the pre-tax profit. The last items after the pre-tax profit will be the tax expense, of course, and then there could be some small adjustments that I won't really get too much into this video because they're a little bit more nuanced, but things like income and loss from discontinued operations, as well as amounts due to affiliates for consolidated subsidiaries not fully owned, those will be adjusted for as well. And that gets us to the bottom line. The bottom line on the income statement is going to be net profit or net earnings or net income that is due to the common shareholders of the firm that we're looking at. Let's dissect them a little bit more one by one. So let's talk about the gross profit. Now, first of all, when we're talking about profit, it's helpful to put it in the context of the sales of the firm. So we're not just interested in terms of the millions of dollars, what is the profit that you had, but relating to the sales, how much of the sales do you get to keep after we take into account the cost that you have to generate those sales? So gross profit margin is just the gross profit expressed as a percentage of net revenues. It only includes the cost of goods sold or services provided. So how do we interpret the gross profit margin? It captures the production efficiency. Are you able to manage your cost well? It captures the supplier relationships. Are you able to extract good pricing from your material suppliers, from your labor suppliers? It reflects pricing power. So firms that are bigger tends to have more bargaining, more negotiation power, as well as it reflects policies as well. What's the type of contracts we typically have with our vendors, with our suppliers, with our labor force. So it is a combination of firm power, production efficiencies, how well oiled of a machine we're running in terms of our manufacturing, in terms of our supply chains, etc. For the operating profit margin, we're looking at the operating profit again as a percentage of net revenue. It includes the operating expenses such as selling, general, and administrative expense. Sometimes the language that's used is just selling and general expense. So there could be a little bit of a variety of the terminology used here, but this is the basic catch-all category of operating expenses. Included here would be salary to all of your support departments, your finance, your accounting departments, to your administrative staff, to your executive team, things that are not integrally connected to the production or preparation of inventory for sale, but they are operating costs that are necessary to incur every single period, very recurring, very predictable in terms of just running your business. Then in this category, we would also include research and development expense if you have it, advertising expense. It is pretty uncommon to find it as a separate line item on the income statement. We can often find it as a disclosure, specific dollar amount in the footnotes to the financial statements. And if it's just shown as a disclosure, that means it's included together in SG&A as part of that broader category of operating expenses. And also in operating expenses, we will have the allocation of the costs of our long-lived tangible and long-lived intangible assets. If we're buying assets with finite useful lives, those things would be reflected as assets on the balance sheet at the moment that we buy them. But then over the period of usage, we will allocate the cost of those assets to be recognized as depreciation expense for tangible assets and amortization expense for intangible assets. Watch out for future videos that gets into a lot of details in terms of the calculation and the estimates that go into the recognition of these expenses. So again, those are all of our operating expenses. What does it capture? The efficiency of your core activities. How well are you able to control the cost of running your business in addition to the inventory aspect? Are you able to have a lean staff? However, you can't have it too lean because it needs to enable you to generate the sales. So it's a balance in terms of being efficient, but then investing enough in long-term growth of the company. The next subtotal will be the pre-tax profit margin, which is again, pre-tax income as a percentage of sales, and that will include our financing item. So first and foremost, it will include the interest expense. Sometimes companies actually have a profit increasing financing items. So they may have interest and dividend income because they've made investment in government bonds, in corporate bonds, in equity securities. We don't want to include that in operating activities unless you're a financial firm. But for anyone else, this is kind of an additional activity that you have. It's not your primary operating activity. So it will be in the same section as the interest expense, kind of in that financing group, as well as investment gains and losses. Again, one of the future videos, we'll talk about investments in equity securities, what happens when they fluctuate in value. And there are other peripheral or incidental transactions which are not central to the core operations of the business. If you have a building, you decide that you no longer need it and you sell it and you have a gain or loss on the sale of that long-lived productive asset, you don't want to include it in your operating activities because you're not in the business of buying and selling buildings. This is kind of an incidental transaction that stemmed from your operating decision to buy and use this building, but just realities change. Things shifted. So you want to highlight it as a separate one. We also tend to expect these things to be non-recurring. So we think of them as differently in terms of the valuation implication than for something that is sales or that are recurring expenses like cost of goods sold or operating expenses. Some of the other items that are very common in this category is you might have gains and losses from early extinguishment of debt, litigation-related losses, restructuring items related to layoffs, to the closing of facilities, government-related fines might be here as well. One point of reminder, this does not include any transactions that is between the firm and the owners, so things like buying back stock, issuing dividends, getting money in from equity offerings. Don't forget, those are off the income statement completely. What does the pre-tax profit margin capture? It now takes into account your efficiency of production, your efficiency of operations, as well as incidental and peripheral transactions and non-recurring transactions and all of your financing strategic choices as well. It essentially captures a variety of your operational and financing choices without taking into account the impact of tax strategy or tax jurisdiction. The final profit is going to be the net profit, also known as net income or net earnings. That's going to be on the bottom of the income statement. The big thing that's going to include is, of course, the tax expense. Very common terminology is provision for taxes. If a company has discontinued operations and there is a specific definition for that, then the net effects of that division post-tax would be in there as well. And also, if you have net income or net loss that's attributable to non-controlling interest, which is when you have a fully consolidated subsidiary, but you don't actually own 100% of it, that's going to be shown there net of tax as well. Of course, what the net profit margin captures is everything. That is the bottom line profitability out of the sales that you are able to generate to your customers. How much ultimately are you able to keep as profit to your shareholders. If you watch the introductory video, you have seen this comparison before, and I use it to illustrate that the degree of granularity and the degree of disclosure is going to differ across firms just based on their typical presentation format. Home Depot has more subtotals that it shows us. John Deere is a little bit more concise, but it's important for us to understand that the definition of gross profit, definition of operating profit, these are commonly understood. So even if we're not shown these, we have all of the information available to us to do the calculation and to draw the conclusions for ourselves. How different are these various subtotals? Do they really tell us a different story? Well, let's pick a pair of companies, which is probably the most American comparison we can think of. Coca-Cola and Pepsi, the big divide. Are you a Coke drinker or are you a Pepsi drinker? Diet Coke over here. So here I have the Coca-Cola and the Pepsi numbers from the most recent 10Ks. They are in millions of dollars. They're actually pretty similar in terms of the granularity of disclosure. In terms of the operating revenues, Coca-Cola is actually a smaller company. This is often a misconception. People think that because Coca-Cola is often viewed to have a bigger market of the soft drink competition. They're bigger, but they are much more focused on only the beverage industry. Pepsi has a much bigger portfolio of products. Overall, they're actually quite a significantly bigger company. If we look at their cost of goods sold, again, this goes back to the discussion I had in introductory videos. If you watch those 4 videos, if you haven't, I really recommend you start there. When you're looking at 2 companies which are of different size, and here this is a significantly different size, you can't really do an apple to apples comparison if you're just looking at the dollar amounts. You need to scale them for size, and that's exactly what we're doing when we're calculating the margin. We're scaling everything by sales. So now we're saying, what is my gross profit, even controlling for the fact that Coca-Cola is a smaller company, Pepsi is a bigger company. The gross profit of Coca-Cola is quite a bit bigger than of Pepsi. It's about 62% compared to Pepsi's 54%. That tells us that Coca-Cola is better able to control their costs, whether it is about the production efficiency or whether it is about the relationship with the suppliers. They are able to produce their inventory at a lower rate compared to the pricing that they're selling it at. And again, so for the pricing, Coca-Cola and Pepsi are very, very competitive with each other. This is something that they know very well. One can't mark a can to $7 when another one is selling for $2, etc. But on the cost of goods sold, they do have a significant difference. One of the reasons for the difference is that portfolio diversification that I mentioned. Coca-Cola, because they have a smaller offering of products, they're able to optimize the production of those products. Pepsi has a much bigger offering of products, so they need to deal with a more diverse manufacturing base, which means that the economies of scales can't necessarily be applied in the same fashion. So it actually makes sense that their cost of goods sold are relatively higher because of that diversity of their portfolio. Then we go to the expenses. Both of them don't give us a lot of detail. They just have a general category SG&A expense as well as other operating charges. So for example, none of them right in the income statement gives us research and development or advertising. We can find those in the footnotes. And when we go to the operating income, we really see that difference widens, right? The operating income for Coca-Cola is 29%, so they get to retain 29 cents out of every dollar of sales. For Pepsi, it's only 12%. And there could be a variety of differences here. One thing that I will show you is that even though I mentioned before that typically non-recurring items are included lower on the income statement, sometimes depending on their nature and kind of depending conceptually where they belong, sometimes they are actually included higher up. So for Pepsi, I am here in their most recent 10K and I look at their discussion about what are some of the factors that can impact the incomparability of the financial statement line item as compared to how they did last year, and specifically focusing on selling, general, and administrative expense. There are a couple of items here. One is they did have a restructuring and impairment charge, which is pretty significant, $700 million. And they also had some acquisition and divestiture related charges as well. Now we are below the operating income. Now we're in the financing section. And of course, they both have an interest expense. For Pepsi, it's a little bit lower, 1.1 billion. They actually lump together interest expense and interest income. Coca-Cola does separate them out. There's one more thing I wanted to highlight here about the formatting choices. If you watched my introduction to the income statement video, you may remember that I mentioned that majority of the firms choose to show all of their expenses as positive numbers. And typically when firms do that, they will show any profit increasing item on the income statement as a negative number. It creates this slightly weird situation where you see a profit increasing number like a gain shown in parentheses because it's in the expense section. Coca-Cola does something different. We have revenues, we have all of the expenses, as I mentioned, there as positive numbers. But for whatever reason, even when they're talking about profit increasing items such as interest income, they're actually showing it as a positive number, which personally I find it a little bit confusing because this 1654 is a profit decreasing number and 786 is a profit increasing number. Of course, if we carefully read the labels, everything is clear to us. So this is just another example where we have to be careful and pay attention to the details and make sure that we understand the labeling because these are little formatting quirks that just differ from firm to firm. Pepsi doesn't really have a lot going on here in terms of additional activity. Coca-Cola does. In fact, they're able to have a income before income taxes, which is bigger than their operating income. And that's because they have these investments that as the investments make earnings, the portion of that is attributable to Coca-Cola, making additional profit on these non-drink producing, non-food producing items. Then we have the subtotal income before income taxes. We see the tax expense for both companies. Here we have these very slight adjustments for non-controlling interest of fully consolidated subsidiaries. This is the bottom line. The net income is 27% as a margin of total sales for Coca-Cola and 9% for Pepsi. So two very close competitors, but we definitely see significant difference. You might ask, this is just 1 year. How did these companies actually compare to each other over time? So let's take a look at that. Here, I'm going to look at all of their margins from 1990 to 2025. The gross margin has consistently been higher for Coca-Cola. And the interesting part is this is irrespective of size. If we look at the size, when we started the period 1990, Pepsi was bigger. And then as they grew, they were very close for a while. And then they've kind of diverged more and more. But throughout that entire period, consistently, the gross profit of Coca-Cola has been higher. The biggest difference is in 2008, where they're 11% higher. In the smallest difference, 2023, they're 5% higher. The interesting part, even though there's always a difference, if we do a statistical correlation, so that tests how closely the two sets of numbers move together, the correlation is really high. It's 80%. Generally, when we see the gross profit of one goes up, the gross profit of another one goes up as well. And that's because both of them are very much subject to similar pricing from the agricultural sector, from the fuel sector, from the transportation costs. So even though they have individual difference, there's kind of a bigger macroeconomic wins that fill their sales in a very similar fashion. Let's do the same analysis for their operating margin. Coca-Cola has consistently been higher than Pepsi's throughout the entire period. They've expanded that difference just in the recent years to 15%. The Pepsi's cost base being broader doesn't just add complexity in terms of their production, it adds complexity in all other aspects of their operations, and it makes it harder to really optimize the efficiency there. Coca-Cola also has this particular unique model where they franchise with the bottling entities. So their operating costs related to that, relating to bottling, is also going to be controlled. And as I mentioned before, one-time items play a role as well. Pepsi had high expenses in 2025, which could be one of the reasons that this is a year with particularly large difference. If we look at the correlation, so the production was very much driven by similar factors, right? If we introduce a lot of these other operating costs, the correlation actually falls to 57%. The two firms are still moving largely in tandem, but we now have a lot more idiosyncratic firm-specific factors that are not just industry-driven. Now let's incorporate our financing and transitory items. So we're looking here at the pre-tax margin. Coca-Cola is still higher, but the correlation is now all the way down to 16. So you can see that we have a lot more volatility because by nature, transitory items, you have one-time gains and losses. You spin off a division, you did a big acquisition, so there's a bunch of costs associated to that. You get rid of some buildings, you have impairment, you have restructuring, litigation, all of these things, as well as, again, the choice to differentiate that Coca-Cola has in equity investments and other financing items. So now there's a lot more firm-specific volatility that we have in this performance. They're still consistent in terms of the relative positioning, but year to year, we see a lot more diversity. Here's another pair of firms just to finish this off. Again, companies that maybe are not as closely tied in our minds, but are definitely competitors in a similar space. We have General Mills and Mondelez International, and they have a similar picture. If we look at their correlation on the gross profit margin, it's about 70%. Once we incorporate operating expenses, it's down to 23%. So we have a lot more factors that the firm controls and that are not just driven by the costs for the industry as a whole. Once we go to the pre-tax margin, they actually have a negative correlation. That means that we have a lot of years where one goes up and one goes down in terms of their pre-tax profit margin. Those transitory items and those financing things do not move in tandem at all for those two companies. When we go to net profit, that's moderated back to about zero. The bottom line is they move very much in tandem in terms of the top of the income statement. By the time we get to the bottom of the income statement, a lot of more of the firm-specific choices have had an impact, and we see a different picture in terms of the comparison. So just to summarize, earnings, profit, and income, completely acceptable to use those interchangeably, but let's never mistake them for sales or revenues. I hope you enjoyed this video. Please like, subscribe, tell your colleagues and friends, and I'll see you in the next one.